In this video, guys, we look at what is spread trading. Stay tuned. Hey traders, a very warm welcome to you. Alright, so this video on what is spread trading is sponsored by Core Spreads Australia. There's a link to these guys in the description below. They are a company who offers spread trading. Their spreads are very tight. They have a choice of platforms. They have a wide range of markets. And if you're interested in starting spread trading, then there's a link to these guys in the description below. But what we're going to do is a quick guide to what actually is spread trading in this video now. So let's say you've logged on to your Core Trader 2 platform, you're in there, you've decided on the markets, you're looking at the markets and you see this, you know what's going on. So let's explain exactly how it works. So spread trading is basically, the name comes from the spread. So the spread is a difference from the price you buy at to the price you sell at. And basically, there's no commission to pay. The costs to trade are in this spread, which is why it's super important, guys, that you find someone who has a tight spread, because a wider spread means more cost to you. And the more active you are in the markets, let's say you're trading, multiple times a day or multiple times a week across different markets, then that money adds up. And that's money that could be in your pocket or at least in your trading account. So tighter spread, the better. It's the cost to trade. No commission, it's just the spread. So how does it work? So if you logged into your Core Trader 2 platform and you had a little look at, say, the German index, it will perhaps be quoted, obviously it's going to depend on when you're watching this as to what the current price was. It might be quoted at something like 12,501, 12,502. So 12,502 is the price that you can buy at. And if you're buying something, you believe that market is going to go higher. 12,501 is the price that you sell at. So if you sell something and you're opening your trade, it's going short and you believe that market's going lower. That's the beauty. One of the beauties of spread trading is you can speculate on the market going higher or speculate on the market going lower and profit if you're right from both of those eventualities, if you've picked the right direction with your analysis, etc. And the difference between the buy price and the sell price is the spread. So in this case, the spread on this market is 1 point. In some markets, like the currency pairs, it's going to be less than 1 point. In other markets, let's say cryptocurrencies, it's going to be more than 1 point. It's going to vary depending on the market you're trading. So that's important to know as well. So let's have a look at kind of an example. So you've done some due diligence. However you decide to make your trading decisions, you've decided that you think the German index is going to go higher. Now, whether you've done your decision making by analysing the charts, or whether you think there's some news flow that's positive, however you decide to make your trade decisions, you've decided that you think the German index is going to go higher. So in order to speculate at that and profit from that, if you are correct, you would place a buy trade. So you'd go along, you'd open up your ticket and you'd look on here and you go, right, okay, the price I can buy at now is 12,502. And you decide, and obviously you need to make sure the volatility, have a look at the volatility and see where you want to come out if you're wrong, and understand the risks and all those other concepts. But let's say, for example, you decide to do a $5 a point trade at 12,502. So you put your ticket through, you'd hit buy, $5 a point, it'd come through, you'd get a confirmation, that would then show in your trading blotter as an open position. Off you go. Now, two things can happen really. The market can go higher or the market can go lower. Technically, I guess it could stay exactly where it is, but most of the time we're going to move at least 1 point in either direction. So it's assuming either goes higher or it goes lower. Don't forget, if you've got a buy bet in this example, you want that market to go high, because if it goes higher, you're going to make money. So with spread trading, the more correct you are, the more money you will make. If you happen to hit that market just before something great news comes out, or loads of buyers start to step in, or just got to have the start of a big bull run over the next few days or whatever it may be, you're going to make good profits on that. If on the other side you hit the buy button and you're hitting that trade and stuff doesn't go your way, you're going to be in a losing scenario. But the point is, you magnify. The idea actually, guys, with trading is you're trying to keep those losers, because you are going to lose, this happens with trading, keep the losers small and try and get those winners as big as possible so that they outweigh those losers over time. But that's by the by. What you're trying to do now is you're in this trade, you're long technically, which you have this buy trade on, and you want the market to go higher. So we could be in this scenario here. This is scenario 1, and you've bought here at 12,502. I've just put 500 here, but you'd actually be in 12,502. And let's say over the next few days, the market goes up to 12,550. Now, I say days, but you could choose. You can choose how long you want to hold a trade for. That could be days, that could be weeks, that could be hours, that could even be minutes. You could be in the trade for 5 minutes. That's your choice. Now, obviously, the distance the price moves is going to be more, generally speaking, over a longer period of time. You'd expect the market to move more. Now, not to say it can't go higher and come back again, of course, but you expect the volatility to be more, you expect the range to be more the longer you hold it. So you have to adjust your position size to suit that kind of stuff. So again, entirely up to you how long you decide to hold a trade for. You can close it 1 minute after you've opened it. You can close it 30 seconds after you've opened it if you wanted to, but let's assume you've held this now for a couple of days, and maybe the order of magnitude isn't quite right. 50 points on the DAX in a couple of days isn't really right. You'd probably get a lot more on that on the German index, but great example anyway. So the market does rise, and now the quote on the Core Trader 2 platform is 12,550 to 12,551. Same scenario as we had here. That's the price that you sell at, that's the price that you buy at. Because you've already got your buy trade on, you need to now sell to cancel out that position, to close that position effectively. So you sell, so you're closing, you're not actually opening a new position, you're just closing the buy position you've got open. $5 at 12,550, because don't forget it's your sell price. You've locked in 48 points. That's the difference between your 502 and your 550, because you've gone up by 48 points. You've locked that in, so you've made 48 points, and you've made in the dollar amount $240, because it's times by your position size, which is $5. You know, if you've done $50, you'd obviously be $2,400 up, etc. It's magnified by the money you make. Is ultimately decided by the size of your position and the size of the move, and those two multiply together. Let's say you were wrong as well in this example. Let's say you bought it, went your way, but then it came back and you held it and it went lower, and you ended up in a loss situation, which happens from time to time, of course. Trading, there's no guaranteed money in it, but we're trying to keep those losers small. So the market falls and is now quoted at 12,482, 12,483. Remember scenario here, that's our sell price, that's our buy price. So we're gonna have to sell it at 12,482 and take this loss. We sell it to close $5, 12,482. We've lost 20 points on this one because we bought, remember, at 12,502. It's now 82, so 20-point loss. Times our $5, we've lost $100 on that trade. So that's an example if the market went against us and we had to close it for a loss. That's an example if the market went in our favor and we closed it for a win. And then also imagine, guys, that if this carried on, let's say you held it and carried on higher and higher and higher, the more right you are, this is the thing with how spread trading works, the more money you're going to make. So theoretically, if you held that and the market keep going, you could hold that indefinitely and you'd be making incremental profits as the market went in your favor. But of course, it does work against you as well. You could also theoretically hold a losing trade and it will go against you and against you and against you. So you need to manage the risk and understand how to cap the risk and keep things under control and understand volatility and all this kind of stuff with the market you're trading. Anyway, that is spread trading, guys. Go and check out Core Spreads Australia. The link to those guys is in the description below. See if they're the right company for you, and take care whatever you're doing in trading. See you in the next one. Bye bye.